Hi, I'm Marianne Matthews. Well, with the Russell 2000 underperforming the S&P 500 by over 6% last year, 2011 was indeed challenging for the small cap sector. Well, to share their outlook and insights into what lies ahead for 2012, I'm joined by Gord McDougall, who's Vice Chairman and Director, and Phil Cotterill, who's Director of Connor Clark and Lunn Investment Management. Well, thank you both for joining me today.
Nice to be here.
And your team runs the TD Canadian Small Cap Equity Fund, and you've been in the business quite a number of years. How long?
Well, we've been in the small cap business since 1988. That's when we first managed a small cap fund. But it's always been part of our process. So if we take it back to the origin of the firm, that would be 1982. And some of us even have invested
longer than that. Okay. Well, small caps have been known to be always more volatile than large cap. What happened last year? What kind of underperformance? What affected the underperformance, and what do we see going ahead?
Well, I think there's a couple of aspects to what happens in the small cap market, particularly if you compare it to the broader market. Within the small cap portfolio, or the small cap market, company-specific issues are certainly front and center. As a smaller business, we typically have companies that have single product. We have companies that are earlier in their growth cycle, and as a consequence of that, tend to be more volatile. Companies that require financing, so access to capital markets, and when things turn off, or as was the case last year where we moved to an environment where investors are moving away from risk, financing becomes a little bit more difficult. We have businesses that are really focused on the success or failure of a management team that is usually dominated by one individual, which is one of the reasons why, in terms of our process, we really focus on in-depth management interviews, getting to know businesses, and really understanding the direction of what happens in a business. So companies, that the results in portfolios and in the market are really concentrated around the success of individual businesses.
And what do you see going forward if you look ahead? What's going on in the sector?
Well, I just want to add something to Phil's, and then I'll elaborate on that. In the small cap cycle too, it's also dominated by macro, what's going on in the big global picture, and that was a big influence last year and a big reason for volatility. It emphasizes the point that Phil made, that you have to know the companies really, really well. This year, where we are, if we look at a business cycle, we're in the earnings-driven phase of the market. So small caps should do pretty well, but again, it's down to stock picking.
All right.
I think less influence from macro this year, but still certainly some.
And a lot of times small caps really lead coming out of a recession, so it's usually very positive for them.
They do lead coming out of a recession, and in 2009, after the bottom in March 2009, they were up some 55% in the year following.
So what role or allocation do you see as small caps playing in a portfolio?
I think that's an interesting question, because small cap stocks are very complementary. A component of small cap stocks is very complementary in a core type of equity portfolio where you're looking for a little extra growth. So notwithstanding the fact that there is some volatility, and as Gord mentioned, there are periods of underperformance or outperformance of small cap versus large cap, they represent an opportunity for a core equity portfolio to attract a little bit of additional growth into the portfolio return.
All right. And any specific number would you go for allocation?
You know, I think that in a Canadian equity portfolio, anyone should have maybe 10% of their total Canadian equity portfolio in small caps, but it really is all about what's your investment objective, how much risk are you willing to take, and it should be diversified.
Yeah, and I think it's important where small cap has outperformed the rest of the portfolio that investors begin to rebalance their portfolio by directing cash flows towards the part of the market that has underperformed. And then when small cap underperforms, that there's a reallocation towards the smaller cap area. So there's a natural rebalancing that can occur in the portfolio.
And as you said, it's very cyclical.
Very cyclical.
So small cap investing, as we talked about, requires a lot of extra due diligence. And for individuals or investors looking to maybe either enter the space, maybe they're new, maybe they haven't had too much success, what would you suggest?
We've already talked enough about the due diligence and how important it is to get to know management teams and the people that drive those companies. So if you're looking at a specific manager, you want to know their record. You want to know not just their performance record, you want to know what's their process, who are their people, how long have they been there, what it is they actually do day to day, and what kind of relationships do they have with these managements of these companies. That's the key.
I mean, I've always been a proponent as a portfolio manager of a portfolio management or a diversified approach. And I think that's even more relevant in the small cap area where you have such significant single security risks or issues within specific businesses. You really want to have a well-diversified approach to this part of the market.
All right, and let's talk some stocks. You brought some names of ones that you like.
Again, we'll talk about diversification. I mentioned earlier there's something like 110 names in the portfolio at year end. The biggest position in the portfolio today is a company called Capstone, 2.5% weight in the portfolio. So you can see the reason for diversification here. It's a utility trust. And in December of 2011, they announced that they expected that their cash flow in their payout ratio in 2012, when they looked at what would be coming into the company, would exceed 120%. Red flags. It means dividends going to be cut, payouts going to be cut. The stock fell in half to about $3 price. We think that a company like this that's got good renewable energy and has just recontracted its Cardinal plant, which is the biggest asset that it's got, can probably cash flow 7 to 8% per year. And that, the way we would analyze it and build a price out of it, would give us a target price of about $5.50. And if we used an NAV, a net asset value on the company, it probably exceeds $6. So at $3, around the $3 level, which is where it was at year end, very attractive to us. So we think that it will get recognized in the year ahead as people get more comfortable about what is the new cash flow, what is the new dividend.
Maybe I'll talk a bit about a smaller holding in the portfolio, but one that we find also very interesting. And actually, maybe somewhat ironically, given that the small cap sector today is made up largely of cyclical businesses and oriented towards materials and energy. The stock that I'll speak about just here momentarily is in the financial sector. It's a real estate company, and it's a company called MI Development, which was spun out of Magna about a decade ago. It was designed to hold, or it was intended to hold, the operating real estate assets of Magna. It wasn't particularly well run. It was very focused on Magna operations. Like Magna's auto business, it is well overcapitalized. The company has about 10% debt to value, which is quite low in relation to its peers. Its peers would typically be about 50%. Frank Stronach is no longer involved in this business, and management has refocused in terms of extending the leases, upgrading the leases. Magna is actually a very good tenant, very good quality tenant, so very stable cash flow. This is a business today that has about a 6.3% dividend yield, which is quite unusual in the small cap space. The cap rate on the cash flow or the valuation of the business is 11.3%. 11.3% is very high in relation to other real estate companies. There's actually no other real estate type business out there that has anything higher than 8%. So if you think about that in a PE context, it means that the PE ratio for companies with an 8% yield is about 12 times, and for this business it's about 9 times. So it's attractively priced. We think there's good upside in the cash flow generation as they reorganize themselves and refocus their business. So it's a company that we're staying close to, that we have an investment in and find attractive here.
All right, and one more?
One more. Let's talk about Surge Energy. Surge Energy's been in the portfolio for 3 years, into its third year now. It's added value in 2010, about 25 basis points to the portfolio by itself, and about 47 basis points last year. What we really like about it is they've been generating production growth of 26%. That's about 10% more than comparables. Their increase in net asset value has been about 30% per year. Again, much better than comparables, and yet it trades at the lower end of a range. Trades at about an 8 times multiple, discounted cash flow multiple, when the range has been 7 to 12 for comparables. So we think with that kind of history and knowing that company well and priced where it is, again, it's attractive.
All right, so lots of options for either the do-it-yourself investor who wants to dig in there or someone who wants to let someone else look after their portfolio. Well, thank you very much.
Thank you.
Thank you.
I've been joined by Gord McDougall and Phil Cotterill from Connor Clark and Line Investment Management. Thanks for watching, and join us again next week. Before you decide to invest, make sure you do your homework and ensure that the investment is aligned to who you are as an investor, including your asset allocation and your tolerance for risk.